Gupta joins us. Let's take our conversation forward and understand what he makes of the current market action. Ashish, good morning. Thank you for joining us. The script of how markets moved in 2023 was a function of liquidity, topping out of inflation, and how the corporate cycle picked up, earning cycle picked up. What do you think will influence the script of 2024?
So thanks for having me today. I think firstly, couple of big headwinds that were there at the start of last year are actually tailwinds for the market, right? So whether we look at flows last year, which were expected to be impacted by the rise in global rates, I think that has turned on its head. Similarly, commodity prices, in particular, oil prices were elevated, and with increasing geopolitical risk, that was a concern for the market. And I think that also has turned into a big tailwind. And while these tailwinds are there, I think some of the factors that drove the market last year are still very much present. We expect the Indian earnings trajectory to remain fairly robust. Even this quarter, we are expecting close to 20% earnings growth to reported by corporate India. And I think this will continue to be the primary driver of the markets.
Okay, while the economy will do well,
Yes.
earnings will grow. How much of the good news is in the price? You know, they always say markets look forward. So are markets really looking
Yes.
forward?
Yeah. So I think there is a different level of optimism priced in different pockets of the economy, right? Different pockets of the market. And I think the bigger differentiation that is visible is really the valuation gap that is there now between the large cap and the mid and small caps. Whole of last year, in fact, the large caps actually underperformed the earnings growth they had. And many of the large caps today are cheaper than they were a year ago.
Could you give me an example where small and mid cap stocks have run ahead of themselves and you would say that, look, I will either be a seller or I will not advise anybody to buy them? Give me an example.
So I'll refrain from naming a particular stock, but let me kind of try to address it differently, right? So I think there is quite a bit of optimism that is built into a lot of industrial and capex names. Of course, for good reason, we are still at the early part of uh, the capex cycle, and the trends are very promising. But if you, for example, look at the consumption side of the market, that continues to remain soft. The near-term trends have not been encouraging. Even this quarter, consumption companies are not expected to really accelerate growth. Having said that, many of them have seen the valuations moderate. And in many of these companies, now valuations are very similar to what it is there for the industrial sector. Right? So I think the premium that consumption companies had to industrial companies is contracted significantly, and that's an interesting part of the market now.
But Ashish, to the point that you were making about the optimism in industrials and capex theme stocks, isn't it already priced to perfection?
Yeah, so I think it is priced, and therefore I think more than re-rating, we have to see growth here coming in line with the earnings trajectory. I think what gives us confidence is that we are probably in the second year of an upcycle. Typically, these investment and re-leveraging cycle lasts 7 to 8 years. Right, so we are still in the early part of the cycle, and therefore, I think despite the fact that the stocks have re-rated, we believe there is enough earnings upside over the next few years.
I'd like to draw your attention to themes which, in a sense, are very government dominated themes: defense, railways.
Sure.
As a fund manager, how would you manage the risk here? There is election volatility. You don't know how things would move in the election and how policy making would change after election. So would you be looking at raising cash? Would you be getting out of some of these so-called PSU names now?
Oh, I think many of these themes are secular. I think some of the changes we have seen in terms of indigenization, etc., I think is not really dependent on just on the election outcomes. And frankly, after the state election result, there is increased confidence on policy continuity. Having said that, I think in some of these companies, one have to be cognizant of the fact that uh, the order book to revenue conversion does not always happen at the pace the market expects, right? So I think that is something which we would be a kind of more circumspect about and calibrated about rather than really policy continuity.
Track banks with a magnifying glass. Now, the consensus view is that, okay, banks is where the growth is, banks is where the visibility is, banks is where the valuations are attractive.
Yes.
But some would say that the reality is different because base effect has kicked in, the war of liability continues. Banks will only lend if they have enough deposits, and right now, all the fresh savings are moving either into real estate or they are moving into stock markets. And if that was not enough, it is also moving into options trading now. So there is a challenge in terms of new liability which is getting generated, and that could really bring the banking growth down.
No, I think if you see the banking deposit growth, actually that has picked up from about a year ago, right? So despite what you mentioned, the fact that deposit growth today is happening closer to 13% compared to 18 months ago when it was more than the 10-11% range. And in fact, the deposit growth for banks, yeah, one of the biggest variables itself is the credit creation in the economy. So the credit creation in the economy has remained robust. Deposit growth has also picked up. And I think that will continue to be the case. However, I do agree that base of bank earnings has gone up. Last year, we were probably at some sort of a cyclical high in terms of bank ROA, not just because the margins were elevated, but also because credit costs have been unusually subdued because we were coming from a post-COVID period. And given that, definitely there will be a moderation in ROA for the banking sector in the coming year. Having said that, as you mentioned, banks have underperformed last year, and the markets really did not pay up for the fact that ROAs for the banks improved. And therefore, despite the fact that return on assets for banks has peaked out and will be moderating, I think the valuations are really comfortable enough for us to be positive on the sector.
Morning. Given the fact that we're surrounded in the city of Mumbai with a lot of infrastructure that's taking place, it is the election year as well. How are you looking at this very capex oriented theme playing out for the year ahead?
I think it's quite interesting. I think both capex, real estate are sectors that are emerging after the multi-years of down cycle. And therefore, the ROE recovery in many of these companies is very, very sharp. As was talked about earlier on the show, some of this has priced in. I think some of this still has to play out. And we are actually still positive on this theme.
Do you see that your fund positioning changing in any meaningful manner in the run up to the election? Could you be raising cash? Would you be buying puts? How would you hedge the event risk?
So I think firstly, typically we do not try to change fund positioning for particular events. I think it is really very difficult to predict, and I think we orient our funds to participate in long-term trend. So we really don't position them for particular events. Having said that, I think what has transpired in the last quarter in terms of state election results. I frankly believe this year the bigger risk for the Indian and global markets is going to be election outcomes from the US. I think there's a larger amount of uncertainty relating to that compared to the Indian election.
A lot of market old timers are saying that there is bubble and trouble in small cap stocks at every level, SME, or for that matter micro caps. I look at flows into mutual funds. Amphi data which came I think on Monday, it talks about 20% of the fresh SIP flows is moving into small and mid cap stocks.
Yes.
How do you see that space moving? I understand valuation is a concern there, but a fund manager has a mandate to buy small cap stocks. If you get 3,000-4,000 crores on a monthly basis, the option is to buy them more. So how will this entire space move? Because one side is valuation, second time is flow and sentiment and momentum.
So I think the mutual fund industry is cognizant of the fact that there is increasing valuation differential. The regulator also allows a fair bit of leeway in small and mid cap funds. So, for example, in the large cap funds, mutual funds have to minimum own 80% in large caps. In small and mid caps, you can own only about 65%, and 35% can be non-small cap holdings. And if you look across the industry, I think there are multiple funds where uh, in a small cap fund, the holding of small caps is not maxed out. And in fact, people have actually given the valuation differential, either increasing the cash holding in a small cap fund or increasing the holding of large caps. So I think those are some tools fund managers are using to kind of mitigate the impact of the fact that the flows are getting concentrated into one pocket of the market. Uh, yes, the valuation differential is large, but we also have to recognize the fact that a lot of earnings growth, if you see last year, was really coming in this mid and small cap space, right? So if you look at mid and small caps, their earnings last quarter grew nearly 45% year on year, right? So many of the domestic themes that we talk about, whether it is manufacturing companies, industrial companies, real estate companies, hotel companies, these are represented in the mid and small caps and not really in the large caps, right? So the large caps are typically your banks, a few conglomerates, IT services companies. So the earnings trajectory in the mid and small caps, given the sectors they represent, is also high.
Ashish, great to chat with you today. Thanks as always for taking the time out and joining in.
Okay, thank you.